All right, here we go. The final showdown. The concept, paying down your mortgage. Two strategies, velocity banking versus paying down your principal. We're going to beat this one up. We're going to dissect it. And we're going to lay this argument to rest. Here are the inputs. $10,000 income. You have a mortgage loan of $500,000. Mortgage rate, 6.5%. If you're in the future, that's 2% over the US Treasury rate right now, the 10-year. Loan term, 30 years. Therefore, your mortgage, 3160.34. You have $5,000 of living expenses per month. The kids love camp. The wife likes going out. You enjoy golf, whatever. Total monthly expenses, 8160. That brings you a net income of 1839.66 of savings, okay? Sometimes it's referred to as cash flow on some of the velocity banking videos. You have a line of credit of $20,000. The line of credit rate, 9%. Again, if you're in the future, SOFR plus 4.5 is what I did. Here we go. The first one up to start duking it out. Velocity banking. If you don't know what velocity banking is, I have another video. It's a minute long. It explains the concept. It uses visuals. It's super easy to understand. For the sake of this video, I'm assuming you understand what it is. All right, so here's how I set this up. You close on your house. First month, you're exhausted. Okay, you're not going to do anything. Just going to pay the mortgage. You're pooped. Second month, you decide to start implementing velocity banking. You take the $20,000 and you chunk it over to the mortgage balance. You still pay your normal mortgage. And for this calculation, you get $10,000 a month. I split that up. Okay, you get paid every 2 weeks. So you get paid $5,000. You pay down the line of credit balance. And of course, you've already paid the mortgage that month. You get paid again 2 weeks later. Now, I'm really trying to help velocity banking here. I'm going to give it all the power I can to try to win this battle. Okay? I am purposely putting the payment of your expenses at the very end of the month. Okay? I'm doing this to allow the average daily balance to be essentially benefited from your income that came in. That might be possible, by the way. You might have a credit card bill that's due at the end of the month, and all your expenses can go on a credit card. So that this is possible to do. The next month, you do it again. You pay down with your income. You pay down again with your income. And you pay out with your expenses. And you do this over and over again. If you watch my other video, do this over and over again until the line of credit's at zero, which at that point, you then take the line of credit again and you chunk it back over to the principal. You do this over and over again until the mortgage is at zero and the line of credit's at zero. What type of interest rate did we pay in total with this strategy? We will find out, sure enough, at the end of the battle. All right, now really quick, very important to note in velocity banking is the strategy is taking the entire income, your entire income, and throwing it into the line of credit balance. Okay, it's the same thing, by the way. These are all synonyms as throwing all your income to debt. Whether it's thrown into a line of credit or whatever, it's thrown into debt. Okay, so my argument here is, well, why do that when we could just throw it back into the original mortgage? All right, so based on that, second contender, the principal paydown method. Again, if you don't know what this is, I have a video on it. I'll share a link in the description. It's a minute long. It's super easy to understand. Similar story. You moved in. You're exhausted. You're not doing anything. That first month, I'm just going to pay the mortgage and that's it. I don't want to do anything. Okay. The next month, you decide to do a principal paydown. Now notice, I'm trying to hurt principal paydown here. I'm giving velocity banking its chance. What I'm doing here is, because you get paid twice a month, I'm now splitting also that $1,800 to two separate payments. I technically can make this first one the full $1,800, and that would certainly help principal paydown. But just to try to give velocity banking its chance, we're going to split it up. All right? So you add $919.83. And halfway through, you get paid. You add another $919.83. And you continue. By the way, notice how this is a lot simpler. You just continue through every 2 weeks, adding that excess income, those savings, which, by the way, is exactly what you're doing in velocity banking anyways, okay? All right. Here we go. The big reveal. Who wins this battle? Okay? Let's recap. Velocity banking, and the argument, by the way, tends to be, hey, look it, the average daily interest is $4.48. And when you pay off some income, it goes down. Well, then it goes back up and down and up and down. The argument is that that's saving you money. That's the argument, ultimately. Let's see, folks, the final summary. Ooh, this is so exciting, right? Who's excited? Who's excited? Let's do this. Velocity banking. There's your total payment. Total mortgage interest. Total line of credit interest. Don't forget you're paying on that line of credit. Total net interest. Here we go. This is what we all care about. This in the next column. $226,658.41. You pay off the mortgage and the line of credit. 4,399 days. About 12.1 years. 147.2 months. Yes, that is faster than the original mortgage only, the minimum payment. That's the argument, and it's cringeworthy on these videos that's what they're comparing it to, by the way. But what about the principal paydown? Here we go. This is it, the big reveal. Oh, I got to highlight these two. I got to highlight these next two columns here. This is what we care about. You can already see the answer. Interest on principal paydown, 224, 269, 32, 4,416 days. The difference. Here we go. Who's the winner? Principal paydown. You pay more money with velocity banking. Go ahead and brag about your 17 days. Fine, you saved 17 days out of 4,400. You paid it off faster, indeed. Good, congratulations. Don't forget, we gave all the benefit to velocity banking here. I could have paid that $1,800. But you pay more in interest. That's it, folks. That is it. That is it. What else can you say about that? I want to hear the argument. I did the daily average daily interest for the lock all the way through. And maybe I'll show another video. I did all 4,000 cells. I went all the way down. My computer's slowing down. There's so many cells. I did it on the principal paydown method. The 919 all the way through. Here's the summary. You pay more velocity banking. That's it. Discussion is over. I hope you guys get a lot of value from this. The proof is in the calculation. And I don't really know what else to say here. I'm just going to sit here. Think about it. Ask me some questions. I'm around. I'm waiting.